Okay, so let's learn a new concept consideration. So a buyer, they buy a new car, but they trade in an older car, okay, as partial considerations for the purchase, in addition to paying 20,000. So the buyer received a new car, the buyer gave away an older car, that's non-cash, and cash 20,000, okay? So we call this older car as a non-cash consideration. And the 20,000 is the cash consideration. Okay, this is just terminologies. So you understand what we mean by the considerations. Okay, in this kind of, this is the typical transactions for the purchase of the car, right? You're trading your older car, and you know, on top of that, you pay a certain amount of money, you get a new car, right? Okay, this is the antique car, right? I will never trade in an antique car, right? You just need to paint it; it will look nice. So you know what is considerations, right? Non-cash, cash, okay? So when we determine the transaction price, okay, if there's a non-cash considerations involved, okay, so then how are we gonna deal with it? So for non-cash consideration, as you can see, this piggy bank, right? There's no cash, so that's why it's non-cash transaction. So suppose the older car, right? You estimate the older car, the fair value, you estimate it to be 7,500. So then your transaction price for this transaction price, okay, should be 7,500 plus 20,000. So the transaction price should be 27,500, right? Okay. So you could estimate the fair value of the non-cash consideration. What if you cannot estimate the fair value, right? You know, it's a very unique product, right? It's hard to estimate the fair value. It was not sold anywhere else, right? You don't have reference prices. So then, but you know how much it cost for the new car, right? So if the new car, right, you sell it for 28,000, okay? So that's the transaction price, right? The new car would be, the selling price would be transaction price. But this implies the value of the old car to be 8,000. Because you know the transaction price is 28,000, you paid in cash 20,000, so whatever left, you trade in your older car. So that's $8,000 value, right? Okay, this situation is about a significant financing component. Significant financing component. Well, in the finance course, you learn about the time value of money, right? Time value of money. Okay, so basically, you are saying that the future value, the future money, does not worth as much in the present time, at the present time, right? So suppose the interest rate is 10%. If you deposit $1,000 to the bank today, okay, this money, this deposit will grow to close to 2,000 in 7 years, okay? So this tells me that in 7 years, $2,000 is equivalent to $1,000 this year, now, right? So the future money, right, the $2,000 in 7 years later is only worth $1,000 today, right? You see the time value of money? Okay, so suppose, okay, your customer signed a contract with you, right? The customer was saying that, you know, I don't have cash now. I will pay you $2,000 7 years later, okay? And you have fulfilled your performance obligation now, right? You are able to recognize your revenue. You have fulfilled your performance obligation, okay? Would you recognize the revenue of $2,000? So 7 years later, they are paying you cash, like $2,000, right?
I would say yes. You would recognize that as a deferred revenue?
Yeah, you definitely recognize the revenue. I was saying that we assume you have fulfilled your performance obligation. So you can recognize your revenue. It's not a deferred revenue, right? But for what amount you're going to recognize the revenue?
Less than
Same amount.
Okay, one by one. Sorry, I can't hear very well.
Like the 1,000.
1,000. Thank you, right? Because the $2,000 7 years later, right, is only worth 1,000 this year, right? Now. So when you recognize your revenue, you should not recognize 2,000. The present value is 1,000, right? 1,000. So this is what we mean when you are determining the transaction price, right? When there's a significant financing component, right? You have to recognize the time value of money. You have to calculate what's the present value of the future cash flows as a result of this contract, okay? Okay. So IFRS 15 allows the reporting entities not to adjust for this financing component if the promised payment will be paid within 1 year, okay? So if it's not 7 years, if it's 1 year, okay, then you still recognize $2,000, okay? You don't have to make adjustment for the time value of money. But if it's more than 1 year, you have to consider the time value of money. The future cash flows, okay, has to be discounted, okay? You have to calculate the present value, okay, when you are determining the transaction price now, right? Now. Okay, so in that example of the sales of the car, there is only single performance obligation, right? You just deliver the car. That's your single performance obligation. But in many situations, okay, they could have multiple performance obligations, okay? Let's look at this example. A cellular phone company offers 2 options to its customers who are interested in buying a J phone, not an iPhone, okay, J phone. So option A, the J phone is provided for $600 to customer who do not sign a contract for the cellular service. Option B, the J phone is provided for $200 for the customers who signed a 2-year contract at $60 per month for the cellular service. I mean, this is, you have experience with this, right? This is very common type of contracts that you have seen, right? If you own a cell phone, you know that this is kind of a common practice. Okay, suppose this J phone has a retail price of $600, and other retailers also sell the J phone for $600. Okay. Now, I want to ask you, what is the amount and timing of revenue this phone company should recognize for each option? In this situation, let's ignore the time value for money. Okay, in this question, we ignore the time value of money. Okay, for option A, anyone want to give a try? Option A.
Just say 600.
600, okay. So that's the amount of revenue, good. When do you recognize this revenue?
Immediately.
Immediately.
Yeah, when you deliver the J phone to
Yeah.
the customer, right? Right, when the customer walks
Exchange.
away with the J phone, right, from the store, right? Very good. This would be very similar to the.
Time yourself, okay?
Do you have a question for me? Okay, okay. It's an accident, probably. So you can see this option A is very similar to the first examples I have given you, right? Now, option B. Option B, so they sell you this phone device for cheaper price, but you have to sign a contract for the service, okay? So tell me how many performance obligations here for the phone company? how many performance obligation in this contract for the phone contract?
So
Two performance.
two,
Two.
Yeah.
Thank you. Two performance obligations. And what are they?
The phone and the
$200.
contract.
like $60.
$60.
Yeah, I hear you. I hear you. So the phone, right? You sell, you
And the
deliver this
contract.
phone to the customer. That's one. And then you have to deliver the service. So every month you are providing a cellular service, right? So you have to deliver that service. Okay. So we have two performance obligations. Okay. So first, let's go through the 5 step. Okay, the 5 step. Is there a contract?
Yes.
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 Okay. How many performance obligations?
Two.
Two.
Number 3, what is the transaction price? What is the
200.
transaction price
$200 and $60.
per month, right? Okay, very
Yeah.
good. Ignore
No,
time value. Ignore time value. Okay. So
No, per month. Per month is $60, and then the cell phone price is 200.
okay, so let's calculate. Let's calculate the transaction price. Okay. So are you seeing my Word document?
Yes.
Okay, transaction price. So you have $200, right, by selling the phone, and you add $60 per month, and this is the 2-year contract, right?
Mhm.
How many months is in 2 years?
24
24.
months, which
24?
is
4 months.
Yeah,
24.
1,440.
yeah, exactly. So remember, the $60 is not collected today, but in this example, we ignore the time value, right? So we kind of assume that, we just count it. We don't discount the future $60 every month, right? We ignore that. So what is transaction price? So anyone have a calculator?
Yeah, 6,240.
600?
6,000?
6,000? Yeah,
Yeah, 240.
240. Is
Yeah.
that right?
So
Yes.
that's 1,040.
$1,640.
$2,040.
1,640.
Okay.
200 plus 1,440.
Yeah, that's right.
Yeah, so
Okay.
1640.
1640?
Yeah.
40, yes.
1640.
40. So this is the transaction price, right? This is step 3. Not bad, right? Step 3 is not bad. What's step 4?
No, I think the transaction price is wrong number, like 200 plus 60 times 24.
It's
Really?
200
After
plus
more-
6.
No, the 200
200
is a
plus.
payment.
Okay.
What was that?
I'm sorry.
No.
Let me. I
The
should have.
200 is a one-time payment, and then the
Okay,
$60 is for two years.
For 2
So-
years.
Okay,
So
let me
24
do it
months.
this way. Okay, I would do a math here. So 20 times 60, that's 1,200, plus 4 times 60, that's 240, and plus 200. So I should have, yeah, there's no problem. This
Yeah.
number is right.
Yes, it's correct.
Oh,
Yeah,
we
it's
don't
correct.
need to. Oh, okay, it's fine.
Okay, so make sure if you are still in doubt, use your calculator, okay? Okay, step 4, okay? Step 4 is, what is step 4? Do you remember?
Step 4 is where you allocate the transaction.
Very
To
good. You
performance.
allocate transaction. Allocate this transaction price to performance obligations, right? Obligations. The first one is the phone, right? The second one is a cellular
Coverage or service.
I forgot how to spell it. Cellular service. Okay.
Yeah.
Okay. So now the question is, the total amount is this. Okay. So I had to allocate this number to the 2 performance obligations, right?
Mhm.
Why do I have to do it that way?
So that you can
different transactions.
Very
you
good.
can recognize the revenue in more detail.
Yeah, very good. Because I'm gonna recognize the phone. I will recognize in step 5. That's step 5. Okay. So let's just focus on the allocation now. So the phone, how much do you think I should allocate to the phone?
200.
200?
200.
Is
200.
that phone cost? Is that value of the phone is 200?
That's how much.
600.
Oh, well,
Six.
you pay the 200 because you
200,
are signing a contract, right? But what's the value of the phone?
Was it 600?
600. Very good. 600, right? Because you won't buy it anywhere else for under 600. Remember, this product is on demand, right? Your competitors is selling this for 600, right? And so then, how much for the cellular service?
60 times
60 baht.
times 24.
The difference?
1,040.
Residual? The residual, right?
40.
Yeah, that's residual. I'm so happy. You guys are accountants, right? You guys are so excited about numbers. When I ask questions about numbers, everyone is answering the question. Okay, so this is the allocation, right? So the phone, right? You allocate 600, and for the cellular service, you allocate $1,040, right? And the total is 1,640. And so this is step 4, and then step 5. When are you going to recognize this revenue, this phone, 600? When?
I would say as soon
Customer
as
takes the phone.
yeah.
Delivery, right? Delivery of the phone, right? Once the customer walked away with the phone, you can recognize that revenue, right? At the point of sale, right? How about the service? The service.
Professor, I have a question.
Yeah.
So for recognizing the phone, is it when they walk away with the phone or when they sign the contract?
When they sign the contract.
Well, you have to give the phone to them. You sign the contract. If you don't give the phone to them, you can't recognize the revenue, right? You have to give the phone to them.
All right.
Yeah. Okay. Because your obligation is to give the phone to the customer, right? The customer is buying a phone from you, right? If you sign the contract, you haven't delivered the phone yet, you cannot recognize the revenue, right? You haven't delivered your service, your product yet. Okay.
Sorry to interrupt. How did you get the 1,040?
It's the
Is
residual.
that 60 times?
Yeah.
24?
So your total, right? Your total is 1,640, and you give 600 to the phone. Whatever life is going for the service, right?
Okay,
There's
sorry.
two
Yeah.
performance obligations. Okay. So when you're going to recognize the cellular service? When?
Every month.
Every month.
Every
Every
month.
time the
At
service
the
is being
end of
performed.
every month, right?
Yes.
That's the time you deliver the service, right?
Yes.
So how much you going to recognize at the end of every month?
$35.
Okay, very good. Apparently somebody is way ahead of me. So this divided by 24, right? So is that 35?
30. Yeah, 35.
Okay, $35 per month. And this will be recognized at the end of every month after you
Yes.
delivered the service, right?
Yes.
So you can see one
Isn't it
contract.
$43?
Sorry, it's
number is not
$43.
43?
That's
43, not 35.
43.3.
$43.3.
43? Okay.
0.3.
Okay.
I was
I'm
like,
sure you'll be able to do this right in the exam, right? Because I'm not a high school math teacher, you know, so it should be okay. Yeah. So then you can see it's quite interesting. There's one contract, but two performance obligations. Okay. And there's a total transaction price for the contract. And you have to learn how to allocate the total transaction price to the different performance obligations because the recognition is at different timing, right? This phone revenue is recognized as soon as the customer walked away with the phone, but the service, you had to recognize over a period of time, right? Okay. Good.
Sorry, one question here. For the
Yeah.
delivery of the phone, like if you're sending the phone to the person, if you're sending it to the person's house, then when would you recognize that? Would it be when they receive it, or once you send it out, then you can recognize?
Yeah, very good question, right? If the customer is not buying from the store, buying online, then it has to be upon the delivery, right? The customer has to sign to recognize the receipt of the product, right?
Okay.
Yeah.
Okay.
Yeah, because you
Yeah.
probably have the company, the online product will be used whatever purator or kind of post, right? They ship it to the customer. location. And for those expensive products, maybe the online company is going to ask them to ask for a signature, right? To acknowledge the receiving, right? So then, once they signed, you got the product, then the performance obligation has been fulfilled. The company has delivered a phone to you. So upon that time, right, the customer signed on a signature pad, the revenue can be recognized.
Okay.
Yeah.
Thank you.
Good.
Hey, Professor, how did you get it 600?
How did I get 600?
What was the
That is the sales price for the phone.
Oh, okay.
Yeah, that's the sales price of the phone, right? Okay, so this is the question. Okay, let's move on. Okay. Again, the business environment is quite complicated, right? If you go to Superstore, right? When you first get entered into the building, there's a wall, and on the wall they hung up all these coupons, right? Do you know that? The coupons, certain product, $1 off, $2 off, right? So, if you are really have a good shopping habit, you want to first check that coupons first, right? To save some money, right? So then we have considerations payable to customer. What do we mean by that, right? So basically, when you issue the coupons, right, the customer can claim some money back by using these coupons, right? So if the manufacturer issuing these coupons, they have liability to the customers, right? When they sell these things, they receive the coupons, they were given coupons, they have this liability, okay, to the customer, because the customer can redeem these coupons for money, right? Okay, so this is one example, okay? This is one example. So this Super Clean Corporation, they were selling a new laundry detergent, okay? So this manufacturer sell 200,000 units to the retailers, okay, at the price of $3, even though it only cost them $1.5. And they issued 400,000 store shelf coupons, and each coupon is $2 worth, okay? So the shoppers can redeem this when they purchase the product, okay? So the estimation is 30% of this 400,000 unit will be redeemed, right? Will be redeemed. Subsequent retailer claims is 250,000. Okay, that's your estimation, 30%. The actual number is $200,000 has been redeemed by the customer. Okay, so let's take a look at what is the implications from the accounting perspective. So what's the journal entry to recognize the sales of the 200,000 units? So the manufacturer will ship 200,000 units to the retailer. Okay, how to recognize this sale? What's the journal entry?
It would be accounts receivable.
Yeah, debit account receivable.
Yeah, that's right. Debit accounts receivable for 600,000.
Yeah.
And sales, credit sales for 600,000.
Credit sales for 600,000, right?
Yeah.
Okay. Did you really sell the product for 600,000?
Well,
not really, right?
No,
because you are giving out some coupons, and that coupons will be redeemed at the cost of the manufacturer, right? Okay. So there's obligations when you sell these products. Keep in mind you also issue the 400,000 coupons, and the customer 30% of that coupons will be redeemed, right? And you have to pay for that, right? You have to pay for that. So there are these obligations. So here's the journal entry. Very good. You recognize the credit sales, $600,000. Okay. At the same time, you want to recognize the amount of potential obligations. So that's calculated by, okay, so we're saying we issued $400,000 units of coupons. 30% is estimated to be redeemed. So 30% times this amount of the coupons, and then times $2 per coupon, right? So you ended up with $240,000. So that's your liability, because this amount of coupons will be redeemed in a dollar value, and you, the manufacturer company has to pay the retailer, right? Yeah. So then your real sales number, right? Even though you are going to collect $600,000, but you have to give back to the customer $240,000. So your real sales is really $360,000. Does this make sense?
Yes.
Yeah.
See, the transaction price is not 600,000 because you have these incentives plans, right? You have these considerations payable to the customer, right? So your sales revenue, the transaction price for the revenue recognition is lower than 600,000. Okay, very good. So now I want, oops, sorry. Okay, don't forget, right? Don't forget about the inventory, right? Don't forget the inventory, cost of goods sold. So you debit the cost of goods sold, you credit the inventory, right? So 200,000 units, and the cost is $1.50, right? So you recognize your inventory, $300,000, and the cost of goods sold, $300,000, right? So don't forget this entry, okay?
Sorry, what is that $8 retail price?
That's between the retailer and the customer. But now we are talking about manufacturer and the retailer.
Okay.
Does that make sense? Because the manufacturer is selling these products to the retailer, right? Not directly to the customer, not directly to the shoppers.
Okay.
Does that make sense? Yeah.
Yes.
So the retailer makes $5 per unit, right? Retailer's cost is $3. They sell to the customer $8, right? So the retailer is making $5. But in this question, we are talking about the revenue recognition of the manufacturer, right? So don't confuse. We are not talking about the revenue recognition for the retailer. We are talking about the revenue recognition for the manufacturer.
Okay.
Okay, so now let's pay attention to this bottom line I highlight with the blue color. Subsequent retailed claims on the coupons collected amounting to $250,000. Remember, this 30% is estimate, right? Nobody knows an accurate percentage ahead of time, right? You don't know, like for sure, you know, the accurate percentage of the amount of coupons will be redeemed, right? But subsequently, you know how many has been claimed, right? And that number is 250, okay? What is our estimate?
240.
We estimate to be 240, right?
Yeah.
And now the real number, right? Later on, we learned it's 250. So what's our journal entry?
You will have to debit.
Yeah, go ahead.
You will have to debit sales revenue by 10,000 and credit consideration payable by 10,000, right? You have
very good. Yeah. Very good. So basically, we are saying, guess what? In the previous journal entry, we underestimate our liability. We only record 240. It should be 250, right? Now I have a new information. I better make the adjustment, right? So I'm going to increase by 10, right? So previously, I overstated my sales revenue by 10. So I'm going to debit the sales revenue. So basically, you debit your sales revenue to make the adjustment to recognize previously you have overstated your sales revenue, okay? And then you credit these considerations, okay? Because you know this is your accounts payable. You are liable to pay the retailer for 250,000. This is the number from the retailer, right? And you're going to close this account. Considerations payable to customer, 240,000, right? Does this make sense?
Yes. Okay.
Yep.
Yeah. Okay. So you can see that, right? It's not always in the first two examples. Very easy, right? To know the transaction price. So I'm still talking about step 3, right? I'm giving all the examples. I'm still on step 3. So how are we going to determine the transaction price, right? Okay. Okay. We are still on step 3. So this is another scenario. Variable considerations. Okay. So this is one example. This BQB company gave 10% discount to retailers only if the purchase volume is more than 500 units every year. Okay. So what happened is in the first half of the year, okay, the company only purchased 200 units. So 200 is under 500, right? So they did not give them discount. So they charged them the full price, $100 per unit. So the sales revenue should be 20,000. So you debit accounts receivable for 20,000. You credit sales revenue for 20,000, right? That's the first half of the year. And then in the second half of the year, okay, this blue color information, they ordered another 400 units. So now, cumulatively, they have ordered 600 units, and that's more than 500 units. And so they should be subject to the 10% discount. So they ordered a discount, so they only charge them $90 per unit. So that's 36,000. So for the blue information, you debit AR, okay? For 36,000, you credit sales revenue for 36,000, right? But they overcharged you, right? They should give you the discount for the 200 units that in the first half of the year, right? They didn't give you the discount because they didn't know, right? You are going to order another 400 units. That is, make it total order to be more than 500, right? So now you have to do a you have to do a green revenue reversal, right? So you recognize, guess what? You know, this revenue, 20,000, is overstated. I should not charge them $100. I should charge $90, right? So I overcharged $10 per unit. So in total, for 200 units, I overcharged $2,000. So I'm going to recognize debit sales revenue. That's a revenue reversal, right? You debit revenue, that's a reversal for 2,000. And you reverse the AR by credit AR 2,000. Is this clear? Do you have any questions?
It's clear.
Clear? Okay, very good. So as you can see that, right, this determination of the transaction price is not always that straightforward, right? When they are involved with estimation, with uncertainties, right? You just have to make the journal entry with your best information, and then subsequently you may have to incorporate the new information to make adjustment, right? So you may not know the transaction price accurately right away. You just have to try your best to come up with a number. And then when you have better information, right, when the uncertainty does not exist anymore, right, you have new information, better information, you are able to make adjustment. So this green color information is the adjustment, right? Revenue reversal. Very good. Okay. So no questions. I'm gonna move on.